Hello and welcome. I'm Rahul, and you're watching me on my Facebook page on my YouTube channel, All of My Talks. And if you're watching me consistently, welcome back to my channel. I always come with an intention to serve you, to give you certain knowledge based on which you can take certain decision, or you can enlighten your own decision making ability. Because I always believe that if you will be talking something valuable, everybody will be benefited from that, and they will take it from their own perspective. So I'm a banker, that I have been working in a bank for more than 10 years, and I have extensive experience of banking industry. If you are in a public sector bank, you have good experience if you have been a manager in a bank. But I will certainly tell you that if you are in big corporates, you will have much more experience in terms of big finance and investment banking. You will have more experience. But whatever we have, we have experience of general banking. Uh, Need-based banking. You can say that because we handle almost 95% of the population of our country, and that is why we know it's actually what is the need in the country, and that is what we talk about, that is what we have knowledge, and that is what we have been going through. So I thought that something I should bring in front of you which should be related to bank. That is what I today I came up with an idea to talk about something important. If you are running a business, you will require working capital. If you are running a business, you will require working capital to run your business, day to day transactions or day to day activities. You want to fulfill that, and for that, you need working capital. You know, Many times you will get it from creditors, whom you get supply on credit, and then you manufacture, then you sell. But you cannot survive only on creditors. You need certain capital, and that capital can be provided by banks. What kind of finance bank can do? Fund based finance, non fund based finance also bank can do. So you can get, in terms of working capital, some kind of term loan. You can get loan against property. You can get, sometimes you can get overdraft. If you have collateral like FDs, you can get that kind of loan also. You can get, if you are doing export import business, then you can get pre-shipment and post-shipment need based finance. They can also finance you on that very point of time. So almost everyone need capital to run business. To I will be talking today about working capital. Because working capital assessment is a bigger part of our banking industry, because we have to provide loans to many people, and many bankers are in search of that kind of knowledge, how to assess working capital. you know so to enrich them, today is thought that I should bring some kind of talk based on that. You can take it easily. You can take it as an infotainment, because I'm not going to draw every kind of knowledge on a whiteboard or any kind of blackboard. I will be talking orally. I want to make you understand exactly, and maybe if you will get 50% of that, you will be beneficial. I will try to make it simple in order to know exactly what I'm talking about. So for working capital assessment, there are 5 ways, 5 methods actually. First one is operating cycle based method. Second one is drawing power based limit calculation. Drawing power based. Third one is turnover method based on NAC committee. Fourth one is MPBF, maximum permissible bank finance. There are 2 methods actually in that very MPBF. First method and second method. And fifth one is cash budget method. Every one is important, each and every single one. All 5 are important in order to understand the concept behind working capital assessment. You cannot leave anyone. Everyone is important. First of all, operating cycle. Understand operating cycle. How to assess operating cycle of a business. Every business has an operating cycle. You know, a NIC committee, which we will talk in later in turnover method, they have actually recommended a working capital cycle of operating cycle of 90 days. So normally they take in turnover method 90 days of period, but I want to make it clear that operating cycle can be more than 90 days, can be less than 90 days, based on the needs of your business. But actually they take 90 days in turnover method. So there you have to take it, as per assumption of the NAC committee. There I will be talking about, that way thing. But operating cycle method, first of all, if you have cash, you will go to buy raw material. Thereafter, raw material, when you will procure raw material, you have to send it for processing, and it will go under process that is called work in progress. Thereafter, it will be created, its yield will be finished goods. It will be in inventory for some time, maybe for 20 days. You have bought raw material, it will take certain days, suppose 10 days or 15 days, whatever you want to take, you can take. Thereafter, it will take 10 days to process that, work in progress. Thereafter, 20 days you will take to process that, as finished goods in inventory. Thereafter, it will take 30 days to send that finished good to debtors. Debtors actually who will sell that. They are taking from you the material on credit. For 30 days, suppose it will take certain time, 30 days to generate cash. When debtor will generate cash, will give you cash. So there is a cycle there. Cash to cash. And this cycle is called operating cycle. Once the cash goes into process and again it is converted into cash, this is called operating cycle. So I want to tell you that suppose 30 days takes for raw material, 10 days take for process of that waiting, work in progress, 30, 10, 40 days. Then you take 20 days for finished goods, inventory, it will be 60 days. And then you take 30 days for debtors to sell that and again give you back cash. All will be 90 days. Suppose you have taken some money on credit from your material provider. You have taken substance material on credit. So that credit day, suppose you have taken credit for 30 days, that will be minus from the cycle. 90 days minus 30 days, it will be 60 days. So suppose in a year, there is a 60-day of cycle for you are generating cash again in your hand. It takes 60 days, because you have also taken 30 days of credit from other people. So it will be minus, So it will be 60 days. If you will divide 365 days or 360 you take, in a year, it will be 6 times, 6 times you are generating the cycle, cash in a year. So one operating cycle is of 60 days, and in a year you generate 6 times. So in order to calculate your working capital based on operating cycle, you have to take consideration. Suppose your turnover is 120 lakh, but you have operating expenses, all expenses that is happening is of 90 lakh. So you have to take operating expenses in numerator and you have to divide from number of cycle of operating cycle. So all is 90, whatever is your expense, 90 lakh suppose, you have to divide it through 6, it will be 15 lakh rupees. It will be your limit of your working capital based on operating cycle method. Did you understand? I hope you could get that. Next one is DP calculation, DP, drawing power limit. And you have to know that this is also used in every concept, because that you have given a limit, working capital limit in a bank, but every month they calculate DP, drawing power, and based on that they will allow you to withdraw the money. They will not allow you the whole capital limit to take, but they will allow you DP. They will calculate DP as well along with that. So it is used also there. So it is important to understand what is drawing power limit, how it is calculated. So in DP, first of all, you have to understand that they take stocks, and what is stock? What is stock? Stock could be in raw material, stock could be in work in progress, stock could be of finished goods. So all together, I'm talking about that. All together you take, this is called stock, plus account receivables, debtors. You are given finished good to sell on credit. That you have to also add. So stocks plus your debtors, that you have to add. That is called book debt. But there is a scene also there, that you have payables also. You have your own creditor who has given you certain money. So that is called payables. So first of all, you have to reduce that payables, person who have given you money from the stock, because you have used that payable money in your working capital, as a working capital in your finished goods or in your work in progress or in your raw material. You have used that very money. So that money you have to subtract from your stock. So you have to less that very payables minus certain margin you have to keep, on that very stock. Certain margin you have to keep. Bank takes certain margin, and it could be from 25% to 40%. Suppose on a stock they take generally 25%. So 25% margin you have to minus 1 minus 0.25, 0.75. You multiply with 0.75 in your stock value, less payables, plus book debts. I have already told that certain receivables you will have. Book debts also you can take, and it should be less than 90 days. And if its quality is good, margin will be less. Otherwise, margin could go to up to 40%. Suppose 40% is margin on your book debts, on your receivables. So 40% margin they will take on your book debt. So 1 minus 0.40 multiplied by 0.60. You add up that, you get your DP. This is called DP, drawing power calculation of limit. You understood that? I'm just trying to tell you orally. You can go and you can watch other videos, who have given explanation on whiteboards or blackboards. I don't have access to that and don't have time to implement that kind of thing. But certainly, if I will get more views, in future I will bring that if it is needed, But I'm just orally, I will make it clear to your mind, whatever is needed. First one has been clear, the operating cycle method. Second one has been clear, drawing power calculation. Third one is turnover method. RBI has certain guidelines. RBI guidelines accepted NIAC committee recommendations. Based on that NIAC committee recommendation, they have assumption that working capital, that I have told you in operating cycle. So operating cycle, they have considered of 90 days, 3 months period. So if operating cycle will be of 3 months, in a year, how many operating cycle will be there? 12 divided by 3, 4 cycles, So since there are 4 cycles, they have recommended that your annual turnover, your annual sales will have 25% of need of working capital requirement. 25% for one cycle, So 25% of working capital requirement, means 25% of all annual turnover of actual sales, But they will not finance you altogether 25%. They will take certain margin. So they have recommended that 80% of that bank will finance and 20% will be margin. So 80% of 25% of annual sales turnover. So 80% of 25% will become 20%. So 20% of annual sales turnover, or 20% they have recommended will be margin. So 20% of 25% will be 5%, 5% of actual sales turnover. So 20%, of actual sales turnover, bank will finance you. 5% you have to bring margin. So 20% how much? 1/5. So generally you see that the talk that annual sales turnover, they will provide you 1/5 of that. That will be your working capital, bank finance. Many things you have seen that. Even we have a product called GST Advantage. They have taken all the turnover of your GST and divided by 5. They will give you that kind of limit, as simple as that. Based on that, and where it is used, less than 5 crore finance of a small scale industries, and less than 1 crore of finance for other industries. So that you have to keep you in mind. Less than 5 crore, less than 1 crore for other industry, less than 5 crore for a small scale industry, they will use this turnover method. So many of the small businesses it will cover. So it is important to know. It is quite easy. I'm just telling you everything in easy manner, and you'll understand exactly what I want to deliver you, and it will be really easy for you. Next one is maximum permissible bank finance, where it will be used where you will be financing a small scale industries more than 5 crore and other industries more than 1 crore. There it will be used maximum permissible bank finance. Here there is a concept, current asset. We all know that in balance sheet what is current asset. Stocks, work in progress, raw materials, and of finished good. Stocks plus account receivables, your debtors that they have taken from you on credit, your debtors that you have to add, that will come in current asset, plus cash whatever you have, that will come in current assets. So this is the part of balance sheet. So simply understand current asset and current liabilities. Similarly, current liabilities can be defined bank borrowings, which is payable in 1 year. I'm just talking about current asset and current liability, not about long-term debts or long-term sources. I'm not talking about that. Just only understand that here it is only needed current asset and current liabilities. Current liabilities, bank borrowings, and your creditors who have given you credit, So creditor plus bank borrowing becomes current liabilities. There are also minimum little bit part of that. I'm not assuming that here it is not assumed, it is very little, and when that component will be given in balance sheet you can add that, but here you have to understand current asset, current liabilities. What is net working capital or working capital? You can say that net working capital is current asset minus current liabilities. But here you have to take other current liabilities. Total current liabilities minus bank borrowing. Your creditors plus bank borrowing was your current liability. Here bank borrowing you just discard it, which is called other current liabilities. So you get your creditors, other current liabilities. All bank borrowings have been minus from current liabilities. So this is called OCL, other current liabilities. And when you will minus it from current asset, when you will minus it from current asset, you will get working capital gap. Current asset minus OCL, current asset minus, yes, OCL, other current liabilities. I was right, So there you will get working capital gap. This is called working capital gap. Here you have to consider margin. Bank will consider margin. 25% of that working capital gap means they will only finance 75% of working capital gap. This is called MPBF method first. 75% of working capital gap. Working capital gap, current asset minus OCL, other current liabilities. And how you will calculate OCL? OCL is current liability minus bank borrowings. Did you understand? Here you get one working capital gap. You just take 75% of that, 25% is margin. It will be your maximum banking, your permissible bank finance. Second method, which is called stringent method, because their margin is a little bit more. They take margin not of 25% of working capital gap, but 25% of current asset. That's why the margin increases there. The only difference is that you calculate working capital gap similarly, and there you take margin only of current assets, 25% of current assets. That you minus, you will get method second. It is quite easy. I don't have time to give you example in numbers, but I can give you. It will be needed on pen and papers. I will make you understand. One day I will make that. Next one is cash budget method. There are many industries which are seasonal based. There will be orders much more in a season. There will be cash flow later, spread out. So these are called seasonal industries, where these methods won't fit in. So there you have to understand that you have to use cash budget method. How it is calculated? Peak deficit. Peak deficit. You have to keep in your mind peak deficit. How to calculate that? Suppose you have opening balance, something you have to make, opening balance 50. Suppose you have cash receivables in that month something. Thereafter you have certain payments, payments on salaries and other needed operating expenses, that you have payments. Thereafter you have closing balance. Suppose something you have to maintain closing balance all together. So first do you add, opening balance plus your receipt you add, your payments and closing balance you minus, and you see how much deficit is coming. If there is deficit, you write that, because you have to maintain a closing balance also. If there is no deficit, you write that also. For 1 year they will take a spread, for 1 year you have to give that. You understand? For 1 year actual you have to give that, and there they will see that if there is a deficit, big deficit in a month, that will be your limit, working capital limit, big deficit. So this is the method, that is called cash budget method. In turnover, I've left you one point, they will take 2 years of actual turnover. Actual turnover, 2 years of. If your projection is much more than 25% in turnover method, then they will not accept, bank will not accept. They want reasonable growth rate, below 25%. That is reasonable. And if there is a spike, you have to get proof of that, So bank do analysis of that, actual and projection. That why this should not be cheated. For that, they ensure that. So these are the methods that are being used right now to assess working capital. I hope you have understood all that, and if you want more, I will explain it in quite a simple terms. If you will talk about term loans, I have time to make that. I will take in some time and I will try to make it in another video. Video is getting longer. Thank you for listening to me. I hope everything I have cleared you about working capital assessment. Thank you for listening to me.